All right, so I'm going to do a quick real-world example here of why something as simple as a three-term metalog can actually be important. And this is a case I was involved in personally, because some partners and I faced a major decision this was in like 2009 or something, of how much to bid at an FDIC auction for a pool of 1,456 loans from 16 failed banks. And at the time, there were many vulture type investment firms that were buying up all these mortgages, foreclosing on everybody in sight as quickly as they could, make as much money as they could, but throwing people out of their homes. We wanted to do that with a different set of values. We wanted not to throw them out of their homes if we could find a way to work with the borrower to find some kind of reasonable resolution where they could actually stay in their homes, or easily find another place to live, but it would be more voluntary on their part. In any case, that's not the issue of the case here. The issue of the case here is how much did you bid on a pool of loans from 16 failed banks? This is all factual. You can see these banks that failed over here, and the 1,456 loans were just a whole bunch of cats and dogs. Some of them had missing documentation. Some of them were first lien, some of them were second lien, some of them were cross-collateralized. But in any case, the biggest uncertainty that would cause whether the investors could make money or not in this was how much did we end up bidding for the pool. And part of this was going to be financed by the FDIC, but part of it would be money that we actually raised from investors. And the big challenge here, before submitting a bid with very little time, we only had 2 weeks to do the analysis. There's no way to understand 1,456 loans in 2 weeks. Particularly with partial documentation. But the big deal is how much you're going to bid on this pool. And we were able to put the loans in categories, and ultimately our real estate experts said there were, with fewer than 258 categories, you just couldn't assess the 10, 50, 90 probability range for the value of each set of loans. So these are performing first underwater, and they had a 10% chance that we'd get less than 18 million in proceeds. The median was 21, and the 90% chance was that we'd get less than, there'd only be a 10% chance to get more than 22 million. We did that for each of 259. But the question is, what if you add all these up? Well, the problem is these are a bunch of uncertainties that are even correlated with things like the real estate market. So the question is, how do you think about that? Well, in decision analysis for many, many years, what we always did, what we were taught in graduate school was you associate these 10, 50, 90 probability loans with a 3-branch tree, which now becomes quite easy to simulate. You don't have to deal with continuous probability distributions. And you assign probabilities like 25, 50, 25 or 30, 40, 30 in order to reasonably represent the mean or the variance of those. So you break it all into 3-branch trees and do the simulation. Another thing we found out later is we could do the continuous representation like with a 3-term metalog, which is in fact we did do with a precursor of the 3-term metalogs after we learned some things. One of the things, when we did the discrete simulation across the 259 assets, and there's really almost no way to do this without simulation. Actually, I'm going to show you one later, but at the time we didn't know of a way to do it without simulation. What you saw is a very interesting shape. This is the discrete simulation, 259 assets on those 3-branch trees simulated, and then we fit a metalog to it, and you see a distribution with relatively short tails. Our real estate experts pushed back on this right away. They said, there's absolutely no way that the worst we could do on this pool is 170 million in proceeds. There got to be cases in the 150, 160 million dollar range, but these weren't showing up. And I was convinced, and we'd even taken correlation into account, and I was pretty much convinced that we had done the analysis pretty well. Then we proceeded, after some hemming and hawing and trying to figure out what was wrong with all this, then we proceeded to do the analysis with a precursor of the metalog distribution, which would run through these 10, 50, 90 points exactly, but also which had reasonable tails as well. And if you did the simulation with 259 of those, you ended up with a completely different picture. And look at this, the blue curve is the continuous simulation. The red curve is the discrete. What happens is, even if you do 10,000 simulations or whatever, if you start with something like a 3-branch tree that cuts off the tails, guess what? It cuts off the tails of the whole simulation, right? And here we saw that actually there were, cases where you could go below 165 million or even 160 million, and all of a sudden our real estate experts were satisfied with that. That actually led us to a better decision, because when we had this previous curve, some of our partners were saying, well, look, if we can bid higher than this 110 million to be sure to win the auction. We can bid higher here, and we should bid higher here if there's zero probability of being less than 170. But as soon as they saw this, oh, I see, there are chances here where we could still lose money on this thing, then that actually persuaded the whole group of people, especially the general partner who had raised most of the money for this, that actually we should go ahead and stick with a $110 million bid. Ultimately, we did win the auction with a $110 million bid. We ended up owning these 1,456 loans. And just for interest, how did it all come out? Oh, well, first of all, the point I just made, if we had acted on the discrete analysis, we would have made a bad decision. We would have made a bad decision by bidding more, and I know that from having been part of the process. But fortunately, we did have the continuous opportunity available to us. If you fast forward 4 years, we ended up almost at the median of this distribution. Exit proceeds of 183 million. So, it finally did work out in the end, but it was very stressful times, and particularly stressful working with the FDIC, which is not a topic I'm going to go into further right now. All right, so that's an example. Having something that can represent data easily, and even 3-term assessments in closed form, is valuable, for practical purposes. It can make a difference in decision making.